Today we're diving into a topic that sounds boring but actually touches your wallet every single day: interest rates. So, what are they? Why do they move up and down? And how do they really affect you? Let's get into it. You might hear headlines like "interest rates rise" or "rates cut" and wonder, what's the big deal? Well, whether you're borrowing for a car, saving for the future, or just trying to understand the economy, interest rates matter. Here's what we'll cover. 1. What interest rates actually are. 2. Why central banks change them. 3. How those changes impact your money. What are interest rates? At its simplest, an interest rate is the cost of borrowing money, or the payment you get for lending it. For example, you borrow 1,000 Rand at a 10% annual interest rate. That means you'll pay about 100 Rand in interest after 1 year, ignoring compound, fees, etc. Interest rates apply to all kinds of stuff: savings accounts, mortgages, credit cards, bonds. Also, there's the concept of nominal versus real interest rates. The real rate adjusts for inflation. So if inflation is 8% and rate is 10%, your real return is only approximately 2%. How does this affect you? Now the important bit. What does this mean for your day-to-day money? Borrowing. If rates go up, things like home loans, car loans, credit cards cost more. Your monthly payment may go up. Example: the Consumer Financial Protection Bureau found that higher mortgage rates significantly reduce affordability. Saving. If rates are higher, you might get higher returns on savings accounts or fixed income investments. Good for savers. Spending and jobs. When borrowing is expensive, people spend less. Businesses may scale back hiring/investment. That can affect job growth, wage growth. So basically, rate changes can ripple into your loan payments, your savings growth, and even your job/income prospects. Let's walk through a simple example. Suppose you bought a home when your rate was 5%. Now rates rise to 9%. Your monthly payment may increase a lot. That means you could have less to spend, less to save. Or you leave 10,000 Rand in a savings account when rates were 1%. If it goes up to 3 to 4%, your interest earnings go up, though inflation still eats some of it. Key takeaway: when interest rates move, they don't just change a number on paper, they change behavior and decisions. So what can you do? If you have debt, check if you're on a variable interest rate loan, which may increase when rates go up. Consider locking in a fixed rate if it makes sense. If you're saving or investing, if rates are going up, explore savings accounts or fixed income vehicles that benefit. But remember, inflation matters too. Keep an eye on the economic headlines. If central bank signals changes, that could affect your finances soon. Budget for changes. If your next loan payment might creep up, plan ahead. All right, here's the simplified version to remember. Interest rates are the price of money. They are set by big economic forces, but they show up in your loan payments, savings returns, and overall financial decisions. If you liked this video, hit the like button. Subscribe to Explain Varsity and click the bell so you don't miss future videos that make finance simple. Drop a comment. Are you on a fixed or variable rate? And let me know. Thanks for watching, and I'll see you next time where we'll explain another big finance concept in a way that actually makes sense. Bye.